Welcome back to The Deep Dive, the show where we cut through the noise and deliver the insights that genuinely matter. Think about it. How often do you see a headline, maybe a company's stock takes a nosedive after an earnings report, and your immediate reaction is, well, that's it, story over. Time to move on. But what if that initial perception, that immediate gut-level reaction, is actually just the surface? What if there's a far more intricate, strategic long game playing out, almost hidden in plain sight, revealing a narrative that's much more complex and, frankly, far more fascinating than the headlines suggest?
It's a crucial distinction, isn't it? Our brains are wired for immediate reactions, but true understanding, especially in rapidly evolving markets, well, it demands that we look beyond the superficial. Immediate market movements often capture only a fraction of the full picture.
Yeah, especially in sectors as dynamic as digital assets. Absolutely. And today, we are diving headfirst into exactly that scenario with Coinbase, the undisputed giant in the crypto exchange space. We've been sifting through sources, particularly focusing on their recent second quarter results. And yes, at first glance, those numbers certainly triggered a pretty significant stock sell-off, a big one.
They definitely did.
But here's the fascinating contradiction. Top analysts, specifically at Benchmark, are looking at these exact same figures and essentially saying, forget the short-term jitters. This is noise.
Right.
Buy the dip.
It's a classic counter-narrative, isn't it? Challenges the conventional wisdom. It compels you to ask, what foundational elements are they observing that the broader market, reacting impulsively, might be completely overlooking?
And that, for you, is our mission today. We are going to meticulously unpack this apparent contradiction. We'll explore precisely why, despite a clear and undeniable decline in some key financial metrics, some of the sharpest minds in the financial world are actually seeing Coinbase not just as a survivor, but as a very strong, strategically positioned, long-term play. We'll identify the specific signals they're watching, delve into what these signals mean not just for Coinbase's immediate future, but for the trajectory of crypto itself, and ultimately, what these insights might reveal about the evolving digital asset landscape for you. Whether you're an investor, a developer, or just someone trying to make sense of this new digital frontier.
Yeah, connecting those dots is key.
Our primary lens for this deep dive is a really insightful piece titled Coinbase's Long Game, Ignoring Short-Term Dips by Jason Shubnell from The Block, published August 4th, 2025. This article gives us an incredible direct window into the analyst's perspective on a company that's navigating, well, arguably one of the most dynamic, volatile, and rapidly changing markets on the planet.
It's a great starting point for this kind of analysis.
So let's start where most people's eyes would go first. The immediate headline-grabbing picture. We know Coinbase's stock took a hit, selling off by over 15% on a Friday right after their earnings report dropped. For you, the listener, what were the specific raw numbers that triggered such a swift and dramatic market reaction? Why did they appear so concerning at first glance? What caused that immediate rush for the exit?
Right. The numbers, when you look at them in isolation, or maybe through a purely traditional financial lens, they were indeed quite stark. And, they certainly justified an immediate sell-off for short-term traders. The source clearly points out that Coinbase's total revenue declined by a substantial 26% from the first quarter.
26%, that's big.
It is significant for any company, yeah. But for an exchange, the breakdown is even more telling. Transaction revenue, which is like the lifeblood of their core business, it shrank by an even steeper 39% sequentially.
Wow, nearly 40% drop in transaction revenue.
Exactly. And perhaps most alarming for those focused on activity, crypto spot volumes, meaning the actual amount of cryptocurrency traded on their platform, retail and institutional, were down by over 30% compared to the first quarter.
Okay.
These aren't minor blips. These are substantial quarter-over-quarter drops across their most critical operational metrics.
So not just a little dip.
No. So investors accustomed to consistent growth or stable markets, such figures immediately trigger alarms. They signal reduced user engagement, maybe lower market liquidity, perhaps even a loss of market share. In a mature industry, these numbers would almost universally be interpreted as a clear sign of fundamental weakness.
Right. Prompting a sharp divestment.
Precisely. Especially from those prioritizing immediate performance and momentum, the intuitive sort of fear-driven reaction is always to cut losses quickly when top-line numbers show such contraction. This is the noise that initially drowned out any other signals.
Those are undeniably eye-watering declines, especially for a company in what's supposed to be a high-growth sector. But the source also mentions that despite these drops, total trading volume still came in at $237 billion. Now, that number in isolation sounds pretty substantial.
It does.
How does that compare to previous periods? And what does it tell us about the broader market environment at the time? Because for someone just looking at that $237 billion, it might not immediately scream trouble.
That's a critically insightful point, and it's precisely where we begin to distinguish the noise from the true signal. While the $237 billion might seem large, the immediate concern for many was that sharp sequential drop from Q1. We just talked about that.
Yeah.
However, the article provides a crucial, often overlooked comparison. This $237 billion in Q2 actually compares to $226 billion during the same period in 2024.
Ah, okay. Year over year.
Year over year. This is where the narrative truly begins to shift, and it offers a deeper insight for you, the listener. What this tells us is that while there was a significant quarter-over-quarter decline, which certainly points to a softening market or maybe reduced retail enthusiasm in the very short term, the year-over-year comparison reveals a positive increase.
So growth is still happening, just on a longer timescale.
Exactly. It indicates an underlying growth trend when you zoom out and consider a longer time frame. It implies that while crypto markets are undeniably cyclical and prone to intense volatility, the overall adoption and trading volume are still expanding on a more fundamental, long-term trajectory.
Right.
This Q2 sequential dip, then, might be more reflective of a temporary short-term market cycle, maybe influenced by broader macroeconomic headwinds or a period of consolidation after a previous surge, rather than a fundamental flaw in Coinbase's long-term business model or a sustained exodus of users.
That makes sense. It really underscores the importance of context, doesn't it?
Absolutely. For you, the listener, this really highlights the vital importance of looking at different time frames. Don't let a single quarterly snapshot dictate your entire understanding of a company's performance or an industry's health.
It's about seeing the forest, not just one wilting tree.
Well put.
That's a fascinating distinction, truly. It fundamentally challenges the instinct to just focus on the most recent quarter. And then amidst these pretty significant declines, the source reveals that Coinbase actually earned a net income of $1.43 billion. This feels like a hidden bright spot, especially when so much of the initial market focus was solely on the revenue and volume drops. Why is this detail so particularly important? What does it suggest about Coinbase's underlying health?
This is an absolutely critical piece of the puzzle, and frankly, it's often the most overlooked metric when the spotlight is fixated on top-line revenue or trading volumes, especially in high-growth or, notoriously volatile sectors like crypto.
Yeah, everyone loves the volume numbers.
They do. But a positive net income of $1.43 billion, despite those significant revenue and volume contractions, speaks volumes. Firstly, it's a powerful testament to the company's operational efficiency and, more importantly, its robust cost management.
Okay, so they're running lean.
It suggests that, Coinbase has either built a lean operational structure or has been highly strategic in managing its expenses during a downturn. This isn't just about cutting fat, it's about disciplined financial engineering. They've found a way to remain profitable, which in a crypto winter or a period of reduced activity is a remarkable achievement.
That really is impressive.
Secondly, and for you this is key, it provides a very strong counter-narrative to that initial negative perception. While revenue indicates activity, net income demonstrates the company's actual ability to translate that activity, or even lack of activity in core areas, into tangible earnings for shareholders.
It shows resilience.
A significant degree of resilience, and perhaps even strategic financial maneuvering. Unlike many startups or even established companies in nascent industries that just burn through cash during slower periods, Coinbase is proving it can generate substantial profit.
Which is crucial for long-term survival and growth.
Absolutely. It indicates they're not just chasing volume at any cost, they're maintaining an impressive level of financial discipline. This positions them incredibly well to weather future downturns and, crucially, to invest in long-term growth initiatives without relying heavily on external capital.
Okay, now here's where it really gets compelling. Despite those challenging numbers, we've just meticulously dissected numbers that clearly sent the stock tumbling. Benchmark analysts not only maintained but reiterated a buy rating on coin shares, slapping it with a bold $421 price target.
A very bold target.
And they went even further, dismissing the Q2 results as nothing more than a distraction. What precisely do they mean by this distinction between noise versus signal? And why is adopting this framework so utterly crucial for truly grasping Coinbase's actual underlying position?
This is the core intellectual challenge, I think, for any astute investor or observer of dynamic markets. When Benchmark talks about noise versus signal, they're essentially urging you to filter out the short-term fluctuations, the transient market conditions, the daily emotional swings of retail investors. That's the noise. Think of it as static on a radio.
Right, the stuff that grabs headlines but might not matter long term.
Exactly. So things like a temporary dip in transaction volumes due to a broader crypto market downturn or a quarter-over-quarter revenue drop that's likely to normalize with broader market shifts. These are dismissed as temporary distractions.
Okay, so what's the signal then?
The signal, on the other hand, refers to the fundamental, structural, and long-term strategic developments that truly dictate where the company is headed. Its intrinsic value over years, not just months. Benchmark is definitively viewing the Q2 softness as noise, something that will fade. The signal they're fixated on is how the various foundational elements of Coinbase's digital asset platform are strategically coming together right now.
Ah, the bigger picture build-out.
Precisely. Positioning it for sustained, exponential, long-term revenue growth. This isn't about reacting impulsively to a single quarterly report. It's about understanding the deep foundational work being laid. The investments in infrastructure, the strategic partnerships, the regulatory engagement, the product diversification, all of which are quietly building the future, irrespective of immediate market sentiment.
So for you, the listener, this perspective is invaluable. It encourages a shift in thinking.
It really does. It encourages you to adopt a far more strategic, longer-term view in your own analysis. Look past the fleeting daily or quarterly movements and recognize where the real structural value is being created.
It's about seeing the underlying currents, not just the choppy surface waves.
Perfectly put.
So it's about seeing the entire forest and perhaps even understanding the geology beneath it, even if the trees are currently weathering a storm. And Benchmark takes this even further, explicitly stating that it would make a great deal of sense to buy the dip. This is a classic investment strategy. What's the underlying rationale here, especially when you apply it to a company like Coinbase, operating in such a notoriously volatile sector?
The buy the dip strategy is indeed a time-honored approach, and it's particularly potent and relevant in the context of high-growth companies or industries that are inherently cyclical, which crypto undoubtedly is.
Right, cycles are just part of the game in crypto.
They really are. The core rationale is elegantly simple. It implies a profound belief that the current downturn, this dip in the stock price, is fundamentally temporary. It's a conviction that the company's intrinsic value and its future growth prospects far outweigh its immediate, perhaps underwhelming performance.
So it's a bet on the future, not the present.
Exactly. When applied to Coinbase, it's a bold bet on the continued and, frankly, some would say inevitable, long-term adoption of crypto and Web3 technologies. It's a wager that Coinbase, given its dominant market position and strategic build-out, is uniquely poised to capitalize when the broader market inevitably rebounds.
Which historically it always has, eventually.
Yeah, that's the bet, yes. Analysts embracing this view are looking well past the current crypto market lull or even a crypto winter, predicting that a future surge in overall digital asset activity will inevitably lift Coinbase's performance not just to previous highs, but to entirely new plateaus.
So it's not a short-term trade.
Definitely not. This isn't about a quick flip. It's a long-term play that says don't panic and sell low. Instead, view this temporary weakness as a rare opportunity to acquire a fundamentally strong, strategically vital asset at a discount.
So for you, it underlines the need for conviction.
Deep conviction, yeah. In a company's long-term vision and its market positioning, rather than allowing your investment decisions to be dictated by the latest set of quarterly figures or short-term market sentiment. It's a test of patience and foresight.
That makes perfect sense. It's truly a long-term conviction play, requiring you to trust in the bigger picture. Now let's peel back the layers and dig into the 5 core pillars that Benchmark identified as the bedrock for their exceptionally bullish stance on Coinbase. The first one relates to the burgeoning world of stablecoin adoption and a crucial piece of impending legislation. Unpack this for us.
Okay, this first pillar is incredibly significant for Coinbase's long-term revenue diversification. Benchmark points to Coinbase being positioned to benefit significantly from increased stablecoin adoption. And this isn't just a general statement. It's rooted in a very specific, tangible agreement. Coinbase's revenue-sharing deal with Circle Internet Group concerning USDC.
Right, USDC, one of the biggest stablecoins.
Exactly. For context, USDC is one of the largest and most widely used stablecoins, designed to maintain a stable value, typically pegged 1.1 to the US dollar. As more USDC is issued and used, Coinbase, through this agreement, directly benefits from the yield generated on the reserves backing those stablecoins.
Ah, so it's a revenue stream tied to the use of USDC, not just trading it.
Precisely. Now, what truly supercharges this pillar is the anticipated enactment of the Genius Act.
Okay, the regulatory angle.
Yes. For you, the listener, understanding these regulatory tailwinds is key. The Genius Act is designed to bring specific, much-needed regulatory structure and clarity to stablecoins in the U.S.
Why is that so crucial?
Because regulatory uncertainty has been a major inhibitor for broader institutional adoption and the expansion of stablecoin use cases. With clear rules of the road covering aspects like reserve requirements, auditing standards, consumer protection, stablecoins can move beyond just crypto trading.
Into mainstream financial applications.
That's the potential, yes. Imagine a world where stablecoins are seamlessly used for cross-border remittances, making international payments faster and cheaper than traditional banking rails. Or consider their potential in decentralized finance, DeFi, providing liquidity and acting as a neutral digital dollar for lending and borrowing protocols.
Right, DeFi relies heavily on stablecoins.
It does. Even real-world asset tokenization, where assets like real estate or commodities are represented on a blockchain, could heavily rely on stablecoins for settlement. The Genius Act aims to legitimize and secure these use cases, potentially unleashing a torrent of new stablecoin activity.
And every increase in USDC adoption
Means increased revenue for Coinbase via their Circle agreement. This isn't just about facilitating trading, it's about Coinbase integrating itself as a foundational infrastructure provider in the future of digital finance, where stablecoins could become as ubiquitous as digital dollars are today. It solidifies their position in the plumbing of the future financial system, generating predictable, recurring revenue far less tied to the volatility of spot trading.
Okay, so it's not just about the volume of trades, but about the underlying infrastructure of digital currency itself, with regulatory clarity acting as a massive accelerator. Their second pillar shifts gears slightly, focusing on Coinbase's offerings for institutional players. How exactly is Coinbase positioning itself to capture that colossal institutional market, and what specific legislation is relevant here?
This second pillar is fundamental for Coinbase's long-term stability and sustained growth. It's about moving beyond reliance on individual retail traders. Coinbase is aggressively positioning itself to capture the massive and growing institutional market through two key offerings: its crypto prime brokerage platform and its crypto as a service, or AKAIS offering.
Prime brokerage. That sounds like what traditional finance offers big players.
It is precisely tailored for crypto. For large institutions, think hedge funds, asset managers, family offices. Engaging with crypto is fraught with unique complexities: security, compliance, liquidity.
Right, it's not straightforward for them.
It's not at all. Coinbase's Prime Brokerage provides a comprehensive, integrated suite of services designed specifically for them. This includes institutional-grade trading execution, ensuring deep liquidity for large orders, secure, insured custody solutions, access to financing, and sophisticated prime services. It acts as a one-stop, highly secure, and compliant shop for major players to enter and operate within the crypto space. They need more than just a buy button.
They need the whole toolkit.
Exactly. Risk management, reporting, large-scale portfolio allocation tools.
And what about CAL's course, crypto as a service?
CAS is really interesting. This offering allows non-crypto native enterprises like a major bank, a fintech startup, or even a large retailer to seamlessly integrate crypto solutions directly into their existing products and services, without having to spend years and millions building the underlying blockchain infrastructure themselves.
So like infrastructure on demand for crypto features.
You got it. Imagine a global bank wanting to offer crypto trading to its high net worth clients, or a loyalty program wanting to issue tokenized rewards, or even a gaming company wanting to incorporate NFT marketplaces. Keras provides the APIs and white label solutions for them to do this quickly and compliantly, powered by Coinbase's backend.
Okay, and the regulatory piece here.
That would be the anticipated enactment of the Clarity Act. Much like the Genius Act for stablecoins, the Clarity Act is expected to provide much-needed regulatory clarity specifically for institutional participation in crypto.
Reducing the uncertainty that keeps them on the sideline.
Exactly. It aims to reduce the legal and operational uncertainties. By providing a clearer legal framework, it significantly lowers the barrier to entry for these players, potentially unleashing a flood of institutional capital into the digital asset space.
And Coinbase is ready to catch that flood.
perfectly positioned as the primary beneficiary, with its existing prime brokerage and Cascars infrastructure. Capturing the institutional market is absolutely crucial for long-term stability and growth. It brings in massive capital, enhances liquidity, and lends credibility to the whole ecosystem. It moves Coinbase from being primarily a retail on-ramp to becoming an indispensable foundational partner for the world's largest financial entities venturing into digital assets. It's a robust, enterprise-grade revenue stream, less volatile than retail.
So Coinbase is essentially building the on-ramps and the entire financial infrastructure for the big leagues to come into crypto. But what truly grabs my attention from the source is their third pillar, this massive, almost audacious ambition of developing a super app. What does this concept entail for Coinbase, and why is it considered such a monumental strategic move that could transform their future?
Yeah, the super app vision is nothing short of transformative for Coinbase. It speaks directly to their ambition to become the central, indispensable hub for all things crypto and Web3 for you, the individual user. The concept itself is incredibly ambitious, blending a wide array of functionalities, not just straightforward crypto trading, but also seamless payments, deep integration with DeFi protocols, a robust NFT marketplace, integrated stablecoin services, and even powerful developer tools, all into a single, cohesive, seamless platform.
Wow, so everything in one place.
Pretty much. Imagine for a moment a user journey. You might wake up, use a stablecoin within your Coinbase app to pay for your coffee, then check your DeFi portfolio's yield, perhaps browse some new NFTs, trade a token, and then use a developer tool to build a small, smart contract, all without ever leaving the Coinbase environment.
That sounds incredibly convenient, almost frictionless.
That's the goal. Creating an integrated ecosystem where you can manage virtually all your digital asset needs, and maybe even some traditional financial ones, within one trusted interface.
And the source mentioned integrating DEX, decentralized exchanges.
Yes, and that's particularly strategic. Integrating DXs directly into their platform is a crucial nod towards interoperability. It provides users with even more options and competitive pricing directly within what otherwise looks like a centralized walled garden.
So acknowledging the importance of DeFi.
Absolutely. Offering users the best of both worlds. Bernstein Analysts, as our source notes, even went so far as to liken Coinbase to the Amazon of crypto financial services.
That's a powerful analogy.
It is, and fitting. Just as Amazon became the go-to platform for e-commerce by offering a vast array of products and services, Coinbase aims to be that indispensable platform for digital assets.
The implications are huge then.
Enormous. It creates an incredibly sticky user experience, reducing friction and the need for users to jump between multiple apps. This stickiness, in turn, allows Coinbase to capture multiple revenue streams from a single user base, moving beyond just transaction fees to potentially include subscription services, DeFi yields, NFT marketplace fees, developer tool subscriptions.
Building a massive competitive moat.
Exactly. Fostering an intensely loyal user community and positioning Coinbase at the absolute heart of the evolving digital economy. It's not just a product, it's an ecosystem play designed to make Coinbase an indispensable part of your digital life.
The Amazon of crypto financial services. That really crystallizes the scale of their ambition. It paints a picture of comprehensive user capture. But beyond this grand strategic build-out, Benchmark also pointed to some very recent, almost real-time data as a positive sign. What was that immediate glimmer of a rebound they identified?
Right. This point brings us directly back to the very near future, providing an early, tangible signal of potential market turnaround. Benchmark specifically highlighted Coinbase's projected July transaction revenue. And this isn't just a modest uptick. It's projected to represent a substantial 44% increase from Coinbase's monthly average transaction revenue during the second quarter.
44% increase, just month over month, basically.
Compared to the Q2 average, yes. For you, the listener, understanding why this projection is so significant is key. After the sequential declines we saw in Q2, which reflected that period of reduced crypto activity, this strong July projection suggests a significant potential inflection point.
A turning point.
It may very well signal the beginning of a genuine rebound in overall crypto asset activity and, critically, in trading volumes across the market. Coinbase's operational performance is, by its very nature, incredibly sensitive to overall market cycles.
Sure, when markets are hot, they do well.
Exactly. When the broader crypto market experiences increased trading volume, renewed investor confidence, or significant price movements, Coinbase, as a leading exchange, directly benefits from that heightened activity.
So this July number supports Benchmark's optimism.
It really does. This early indicator in July supports Benchmark's optimistic view that the noise of Q2, that temporary downturn, might already be fading. It implies that perhaps the market has found a temporary bottom or is experiencing a renewed surge of interest, translating directly into more trading on platforms like Coinbase.
So the buy the dip idea isn't just long-term hope.
It suggests it's not just based on long-term strategic plans, but also on early positive shifts in real-time market behavior. It's like an early warning system, suggesting that while Q2 was tough, the immediate data coming out of Q3 might be painting a different, significantly more positive picture.
Adding immediate validation to their long-term conviction.
It's a tangible sign that the tide might genuinely be turning.
So we're seeing not just strategic plays, but also real-time indicators that the broader market might be picking up steam. Finally, Benchmark ties all of these pillars back to the overarching vision of Coinbase's CEO, Brian Armstrong. What is this comprehensive vision, and why, according to Benchmark, should investors focus so intently on it, rather than getting caught up in just the short-term numbers?
This truly is the signal that Benchmark wants you to prioritize above all else. They underscore CEO Brian Armstrong's ambitious vision of Coinbase as an everything exchange for Web3 and the entirety of digital assets.
Everything exchange.
Oh, that's
Sounds
not.
you.
It is. This goes far beyond the traditional notion of a cryptocurrency exchange that simply facilitates buying and selling Bitcoin or Ethereum. Armstrong's vision is about creating a comprehensive foundational platform for the entire decentralized future of the internet.
The operating system for Web3, almost.
That's a good way to think about it. Imagine a world where digital assets underpin not just finance, but also gaming economies, social media interactions, secure digital identity, new forms of programmable money, countless other applications emerging in Web3. Coinbase, in this vision, would be the primary gateway and infrastructure provider for all of it.
So Benchmark's advice is basically ignore the quarterly noise.
Essentially, yes. Their advice is incredibly clear and direct. Investors should be less focused on the company's short-term operating performance and more on the actions it has been taking to realize this expansive vision.
It brings us right back to signal versus noise.
Exactly. It reiterates and reinforces that fundamental framework. The short-term numbers, like the Q2 transaction volumes, are seen as noise, merely reflecting temporary market cycles or fleeting retail sentiment. The signal, on the other hand, is the relentless foundational work being done, the super app, the institutional offerings, the stablecoin strategy, the investments in new tech, all deliberate, methodical steps toward building this everything exchange.
So what does an everything exchange really mean for you, the user or investor?
What it truly implies for you is a platform ready for a world where digital ownership, decentralized applications, and new forms of value exchange become mainstream. It's a long-term bet, not just on the rebound of crypto prices, but on the fundamental paradigm-shifting evolution towards a decentralized internet. Coinbase is positioning itself not just to participate, but to be a primary architect and gateway.
Shaping the future, not just reacting to it.
That's the vision. It emphasizes that Coinbase isn't simply reacting to market conditions. It is actively shaping its indispensable role in what could be the next major iteration of the internet itself. It's a vision that requires looking years, even decades, into the future.
That's a powerful and incredibly expansive vision and everything exchange for the entirety of Web3. It truly does stretch far beyond what we typically imagine when we think of a crypto exchange. And in conjunction with their earnings release, Coinbase also announced some particularly interesting new offerings for U.S. users. What are these new offerings, and what do they really signify about Coinbase's broader diversification strategy and their commitment to this everything exchange vision?
This is precisely where Coinbase starts to significantly expand its addressable market beyond just core cryptocurrency trading, moving into new asset classes, new forms of digital interaction. The source details two upcoming offerings for U.S. users: tokenized stocks and prediction markets.
Okay, tokenized stocks, like
Yeah.
traditional stocks on the blockchain.
Essentially, yes. Digital representations of traditional company shares or even other real-world assets that exist on a blockchain. And this isn't just a fancy digital certificate, it allows for fractional ownership. So you could potentially own a tiny piece of a high-value stock or even real estate, making investment more accessible.
Lowering the barrier to entry for certain assets.
Exactly. It also facilitates 2047 trading, removing the limitations of traditional market hours, and can potentially offer greater transparency and lower fees by leveraging blockchain tech. This offering strategically bridges the gap between traditional finance and the digital asset world. For you, this means a more flexible, accessible way to interact with familiar assets.
Attracting new users, perhaps.
Definitely. Users from traditional finance who might be new to crypto but are drawn by the digital asset advantages for instruments they already understand.
Prediction markets, what are those?
These platforms allow users to bet on the outcome of future events. Could be anything: political elections, sports results, scientific breakthroughs, economic indicators.
Sounds a bit like gambling.
It can be seen that way, but while often associated with speculation, prediction markets also have a fascinating utility in aggregating collective intelligence. They can provide a real-time, incentivized forecast of future events.
So strategic moves, not just novelties.
Absolutely strategic. They expand Coinbase's product suite well beyond just core crypto assets, tapping into new user demographics and positioning the platform for a much wider array of digital asset activities. These fit perfectly into the everything exchange vision by diversifying revenue, attracting a broader user base, and deepening Coinbase's integration into the nascent Web3 economy.
Being ready for anything that can be tokenized or predicted digitally.
You've got it.
So they're not just sitting back and waiting for the core crypto market to rebound. They're actively creating entirely new avenues for engagement and revenue. And finally, another notable detail from the earnings report was Coinbase's recent Bitcoin purchase for its own treasury. What was the scale of this move, and why is it significant for you, the listener, in understanding their long-term conviction?
This particular move sends an incredibly powerful signal of conviction, both to the market and to you, the individual investor or user. The source states that Coinbase purchased a substantial 2,509 BTC in the second quarter.
2,500 Bitcoin. That's not insignificant.
Not at all. This move is significant on a few levels. Firstly, it brings the exchange back into the top 10 public Bitcoin treasury companies globally, placing them alongside major corporate holders like MicroStrategy, Tesla, perhaps in the past, companies that have made strategic bets on Bitcoin's future.
So they're putting their money where their mouth is.
That's one interpretation, yeah. When a company chooses to hold a substantial amount of a specific asset on its balance sheet, especially an asset as volatile as Bitcoin, and particularly during a period of market uncertainty, it communicates a profound message. It can be interpreted as a strong, unwavering signal of the leadership's conviction in Bitcoin's long-term value and its foundational role within the digital asset ecosystem. It's not just a trading product for them, it's a strategic asset.
Could it be a treasury strategy too? Hedging?
It might also be a proactive treasury management strategy, perhaps a hedge against traditional currency inflation, a strategic allocation anticipating future appreciation, or even a statement of confidence that the market bottom is in or nearing. For you, the listener, this is a clear demonstration that Coinbase's leadership isn't just building platforms for others to trade crypto, they are actively putting their own capital and balance sheet behind the asset class itself.
Reinforces the long game idea.
It really does. It reinforces their long game strategy and demonstrates a deep-seated belief in the enduring potential of digital assets, well beyond just their quarterly transaction volumes. It's a vote of confidence from the inside.
What a deep dive.
Yeah.
We've truly peeled back the layers today. We began by observing how an initial headline-driven glance at Coinbase's Q2 numbers might lead to one very immediate conclusion: that stocks sell off. But our meticulous deep dive into the analyst perspectives, particularly from Benchmark, reveals a much more nuanced, multifaceted, and critically a long-term oriented story. It's a classic, compelling case of discerning the signal from the noise in the ever-evolving, often tumultuous world of digital assets.
Precisely. It's about understanding that market reactions are often disproportionately driven by short-term sentiment and transient news cycles. True value and strategic positioning emerge only from a more holistic, forward-looking analysis. Coinbase's continuous build-out of its institutional offerings, its ambitious super app vision, and its expanding product lines are all testament to a foundational, deliberate shift in strategy, designed to transcend fleeting market cycles.
It's a compelling argument for patience.
And conviction in the face of temporary headwinds.
So as we wrap up this deep dive, consider this provocative thought. Given Coinbase's incredibly ambitious everything exchange vision for Web3 and its strategic positioning with that crucial upcoming regulatory clarity we discussed, what entirely new forms of value creation, interaction, or even community might emerge when traditional finance, cutting-edge Web3 applications, and advanced digital assets truly converge seamlessly on a single, unified platform like this? For you as a participant in the digital economy, what transformative new possibilities does this kind of convergence truly unlock, moving beyond what we currently understand about banking or online interaction?
This raises an incredibly important question. It really stretches our imaginations. Picture a future where your traditional bank account seamlessly interacts with decentralized finance protocols without you even realizing the underlying complexity. Imagine effortlessly investing in fractionalized, tokenized real estate across continents with the same ease you currently buy a stock on your phone. Or where your digital identity, fully owned and controlled by you on a blockchain, becomes your passport across all Web3 applications, all accessible through a single, trusted interface.
That sounds revolutionary.
This convergence could mean unprecedented levels of financial inclusivity, breaking down traditional barriers. It could usher in entirely new models of digital ownership, fractionalized shares of everything from art and intellectual property to even tangible infrastructure. Ultimately, it could lead to entirely novel ways to create, exchange, and experience value that we can only just begin to conceive of right now. It's a leap from simply trading assets to participating in a truly integrated digital world.
That's certainly something profound to ponder, isn't it? A
Yeah.
truly integrated digital future. And speaking of engagement, if you found this deep dive valuable, or if you have your own insights on Coinbase's long game or what this future might look like, we'd absolutely love to hear from you.
Yeah, definitely share your thoughts.
Subscribing to our channel, leaving your comments, and simply engaging with our videos really helps to support what we do here. It boosts our visibility in the algorithm and, quite simply, lets us keep creating this kind of quality crypto content tailored for you.
Your support makes a real difference.
It really does. So thank you for joining us on the Deep Dive. We'll see you next time.